Let's go.
Welcome, everyone, to Zephyr's Adjusted for Risk podcast. This is Ryan Nauman, the market strategist here at Zephyr. For years, there's always been that active versus passive debate. Either you were a firm believer that active investment management beat passive, or vice versa, passive investment management was the way to go. It could be polarizing at times, but that line between the two seemed to have blurred over time. Well, I have on a very special guest and the perfect person to talk about active versus passive investment management and much, much more. But before we get started, this episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions. All right, let's go ahead and get started and bring on the star of the show. I'd like to welcome Brooks Friederich. Brooks is the Principal Director, Investment Solutions Strategy at Envestnet PMC. Brooks, thank you so much for coming on the show. It's an honor to have you on. Can you tell us a little bit more about yourself and Envestnet PMC?
Sure. Yeah, Ryan. No, pleasure to be here. Thank you so much. Again, Brooks Friederich here, and like yourself, Ryan. I'm originally from the Midwest, born and raised, and went to school there. Still have a lot of family there. But as I quickly got involved in college and being more involved in the investments and really just our industry that we deal with all day, every day now, started expanding my horizons a bit more. And really, I fell upon Envestnet. I've been at Envestnet, specifically Envestnet PMC, for 17 years now.
Wow.
It's been great. And a little bit more about Envestnet. Envestnet is the wealth platform technology. We're one of the largest wealth platform technologies out there for independent financial advisors. We have over 100,000 financial advisors that use our platform technology to manage their business. I'm specifically part of Envestnet PMC. So PMC is really the in-house asset management arm of the wealth platform. So we do everything from manager research and due diligence into consulting with financial advisors, and then all the way up to our high net worth services that we provide them as well, all built within the infrastructure and the technology that we provide for these independent financial advisors.
Fantastic. Yeah, in our little prep call we had the other day, it was great knowing that you have those Midwest ties to South Dakota, as do I. So it was a fun little conversation. You don't get a whole lot of people with connections to South Dakota in this industry. So
No, not a lot, but it's good. Great people. Still some really great. I stay connected to some great advisors. So those that are listening, they do some just great job of connecting with their clients,
yeah.
using platforms, technologies to scale their business. So it's great. You can find all great types of people on all great different parts of the country, of course.
Yes, you're exactly correct. So, Brooks, a lot has been made about active versus passive investment management over the years. Are we now at a point, years ago it was like your investment portfolios were either active managed or passively managed within the, mutual funds or ETFs within them. Are we at a point where now maybe we're getting past that it's one or the other, but maybe more inclusive rather exclusive, and they both can coexist in the portfolio? It seems like those lines have blurred some.
Yeah, yeah, Ryan. It's a hard yes, maybe a bit biased in my response here, just given how we manage money here at Envestnet PMC, but also a firm belief, and really it goes back to our expertise and our engagement, our history of working with financial advisors. That is our
Okay.
business. We built the technology first and foremost, but at Envestnet PMC, our number one client is financial advisors. We've had a good understanding of how they like to build portfolios, construct, manage, and the products and strategies they're looking for. There always has been, and even more so now, this combination of blending the two investment approaches together, taking active and passive, and beyond the financial advisors is you look at the asset management industry now, which is complex, and there's more and more product coming to market here. So kudos to the asset managers. They're being creative. They're leveraging technology. They're scaling their businesses, and they're bringing different types of investment strategies and different types of wrappers and in different types of investment approaches to investors through financial advisors. So we have a really difficult job alongside advisors of dissecting these complex strategies on and trying to figure out their value proposition, the cost effectiveness of this, their ability to provide outperformance or maybe lack thereof. And hey, this is better suited to be a passive investment option.
Yeah, that's a great point. And, at Zephyr, we do a lot of research. I've done a lot of content on, the different asset classes. Like for example, large blend efficiencies are out there. It's hard to find inefficiencies. The information's out there. So, in a lot of cases, it's better to do passive in that style box. Whereas maybe you go small cap, you're better off. Maybe you can find some alpha there, right? So, like you said, you can combine the two very well there and blend them. You know, with the huge growth of like you were talking about innovation, I don't know if we've seen innovation like we have in the active ETF space. Ton of innovation there, but that actively managed term is not as clear as it once was. What's your definition of being truly active, a truly active investment strategy?
Sure. Yeah. And if you think about active management, we talk about there's two components of total return. So you have your market beta, your benchmark returns, right? So that's your passive component. Great. I just want to participate in this certain market or market segment, whether it's equity, fixed income, whatever it may be. Then there's this excess return, or we use alpha often in the industry.
Yep.
So those are the two components of total return. There's dividends in there, which are a result of investing in types of fixed income securities or dividend paying equities. But those are the two main components. So how do you get the alpha and to get that excess return? I think beta, there's no debate on what passive is, right? Trying
Yeah.
to replicate, get access to market cap weighted indices. But active management for us, what is truly active? Is taking tilts, call them active bets, away from those market cap weighted benchmarks. So again, whether it's equity or fixed income. So if it doesn't look and feel like that pure passive, very low cost benchmark, and you're making active tilts away from that, that's the first check of active. Now, how do we, what is really kind of active in our lens of where we're trying to find active managers? Two components of active management is there's kind of the rules-based systematic active management. Think of your kind of more factor-based investing. There's not a human individuals kind of going deep dive into security selection due diligence. It's more rules-based, algorithmic that's saying they're going to allocate to certain market factors that have over time provided some sort of excess out return. That's an active management through us. They're making an active bet away, but it's more rules-based. It's systematic. And
Yep.
then traditional active management, where you have, an investment team, a portfolio managers, and they're doing all the, ground root due diligence, doing the security selection, overweighting, underweighting sectors, securities, countries, regions, and making those active calls and within that portfolio. So those are the two importance we say active management. And I think, Ryan, honestly, that factor-based investing gets in that gray area a lot. Would say, well, it's passive because it's quantitative, and I think it's tough to say because if a strategy this day and age is quantitatively run by an algorithm that it's not active or that it's passive, that's where the due diligence comes in to try to go try to better understand that strategy. What are they trying to do? Take those active tilts away from pure low cost passive beta.
Yeah. You brought up a very good point there about factors. It kind of seems like factor investing was, making more headlines, a few years ago. It's died down a little bit, but I'm really glad you brought it back up because I think it is important. And you've done a lot of research. Your team has done a lot of research on, that alpha slice and, excess risk adjusted returns. Are there different factors that maybe reward investors with, more excess risk adjusted returns than others?
Yeah, we're strong believers in factor investing. There's a place and time for it. There's benefits of it. There's some really great, asset managers and strategies out there that have a long history of doing factor investing. And again, with maybe a lack of understanding of like, is this active, is this passive? But again, through our lens, these are active strategies. And there's just some well-known, academic tested, market tested factors. You'll call them value, quality, momentum, even the dividend yield or
Okay.
low volatility as well. These are time tested, and a lot of these. individuals from the equity standpoint, a lot of these equities, when you pool them together in a portfolio, the portfolio has this consistent exposure to these factors as well, right? There's a consistency of, yes, value stocks having this value tilt. Is it better off? These are the decisions we have through our due diligence as we're evaluating strategies. Is it better off to you do the due diligence on that manager and say, look at this track record. They're really good at taking advantage of this factor. They have this consistent factor exposure, and they can do it in a more qualitative fashion and more maybe more concentrated. Not owning the
Yeah.
whole 100 to 200 securities, or is it this is more of a time tested approach, like you just want consistent exposure to this factor, and maybe momentum is better used there. Momentum being a stock, a security selector, momentum, you're in and out, you're in and out. Maybe that's better suited for kind of a rules-based, quantitative,
Okay.
algorithmic, owning more securities. And those are the conversations we have as one as we do our own due diligence on the individual strategies, but also as we construct and work with our financial advisor clients and say, okay, here's how we believe active passive. Here's our research study. Here's the different ways to access these factors, whether from fundamental analysis, you're going to have factor exposure by owning these securities, or through a rules-based quantitative algorithmic approach, which is typically more cost-effective as well. And there's no right or wrong. It's just kind of more of the preference of maybe the advisor, maybe our personal preference as well, as you dig into deeper into some of our research studies and say maybe this asset class is better suited for traditional active versus rules-based quantitative active.
Well, that's one point. In terms of innovation, like you're talking about, with factor-based investing, innovation allows financial advisors more tools to get access to those factors, which I think is definitely a benefit and helps that end solution for the investor. But it also, makes that job more difficult, like you said. I was interested when you just said the different factors. You have value, quality, a low vol, you know, somewhat defensive type of factors versus maybe some people would think, it's the growth more aggressive, momentum can be aggressive, maybe small size can be aggressive, but a lot of those factors you mentioned were more on the defensive side, which might be kind of surprising to some.
Correct. Yeah. And I mean, especially the market environment we've had for the last, call it five,
Yeah.
7 years, which has kind of been, we could say it's more of a momentum rally, and it's been driven by, as we know well, some of the largest 5, 7 names, and it's been US driven. And that's been this momentum play and shift. But look at, year-to-date returns as of, May
Mhm.
28th, where we're recording this, Ryan, is it's not so much that history, the same story as it's been the past 5, 7 years, the past most recent market cycle. Not saying it can't come back and still have that momentum trend, but there's some different, factors driving returns as well. Kind of higher quality companies, more stable, and as you said, Ryan, kind of more defensive names that can kind of weather through the market volatility and the market environment we're currently in, which is, as we know well, is a lot of unknowns with tariff policy and everything else going on out there. These types of companies be able to weather through the storm, and that those just haven't been drivers of markets. And it's been a nice run of markets. We've had great returns in the financial markets, especially kind of U.S. as well. But these are these factors very time tested, going back 30, 40 years, looking at back at all of this academic history. And, they're very cyclical in nature. They don't pop these more defensive factors speaking to, Ryan.
But with that being said, too, as you were talking about the primary drivers, whether it's the Magnificent Seven, those mega tech names, you think of growth and aggressive names. But at the same time, those mega tech names, they're high quality stocks too, right? So it's not like quality we're thinking of, the blue chips, old school blue chips of GE and the utilities and stuff like that. These big momentum names, they're high quality. So, it kind of fits that sleeve, I'm assuming.
Very much. Yeah. Yeah. These businesses, of course, we're in a different sort of environment too with some of these large multinational businesses, huge cash balances, and they're going to get picked up on that sort of factor of quality as well. Some of them might have more momentum, and some of them at certain times, the way they're trading might follow into that value kind of a bucket as well. Just
Yeah.
kind of depends. Years ago, Facebook was in the value index for
Yeah.
a little bit, which was right from a valuation standpoint, and these tech names do have these swings of kind of major drawdowns as well. And so kind of that might be a benefit as well with the factor-based investing, rules-based, remove the emotions of investing
Yeah.
but also the benefit of active management of saying, hey, here's our valuation, here's how we're evaluating these companies given their balance sheets, their economic moats, whatever it may be, and kind of sticking with them regardless of how what style box they fall in, right? It's kind of based off of their valuation approach, and they're going to own these companies consistently and trade in and out of them as well,
Yeah.
as well.
Yeah, I'm kind of a firm believer. You mentioned the style boxes. That was great a few years ago, but I think now it's time to evolve, and maybe, in some cases it's good to, pigeonhole a manager in a style box, but as long as they're getting the job done with, excess risk adjusted returns and so on for the client, does it really matter, per se? But, you know, we've talked a lot about active managers. You brought up the volatile markets. A lot of time, it's kind of that train of thought where active management benefits from volatile markets because those active managers can play defense. They can go, increase cash positions. Is that still true today, or are there certain market environments that might benefit active managers that outside of volatility?
Yeah, I mean, our research will show, historically, active management's done a bit better, kind of relative to passive during those more volatile times.
Hmm.
You have, but we really haven't experienced major volatility. We just think of like back to the, COVID, we had that big crash and then that
Yeah.
just swing back so quickly. And it's really tough for active managers. I mean, setting expectations for us as we're evaluating these managers, for them to be on the right side of both those trades. I mean, as we know as investors, it's long-term investing, buy and hold through all this, right? We preach that well. We know that well in our own personal investing. Um, but that wasn't like the typical prime environment for, oh, it was a down market for active management to outperform. It's more of that sustained kind of leg down. And you don't need something as extreme as a great financial crisis either as well. We just haven't kind of behaved from a behavioral standpoint, haven't experienced that sort of traditional market, kind of bear market environment that lasts a little bit longer than a blip on the radar now. A little bit of that earlier this year, and we would expect kind of our thoughts and thinking here is just with the volatility to kick off the year. I think we all do expect with the administration, just with the tariff policy, everything else kind of going on with interest rates and potential inflation. Like it's expected to be some volatile times, right?
Yeah.
We'd expect our active managers to weather through those storms, focusing on their company fundamentals, understanding what these companies are doing to try to kind of get prepared for tariffs, what they're trying to do to kind of store up their balance sheets to have what is there, and maybe they don't have an impact to the tariffs. That's another beautiful thing as well with
Yeah.
these active management. They could say, hey, this company only creates product strategies. Their inputs here are only from the US. Their customers are only US. And that might be more of a small cap names,
Yeah.
small mid cap names. And that's where you get the benefits of active management. And again, it's just to remember as investors, we talk a lot with financial advisors. Advisors have to, of course, tell their end clients, like we haven't been in that market environment. We, of course, don't want to wish and pray for any sort of bear market and sustained down, but it's inevitably going to happen if you've been investing long enough. And active managers are more ripe to outperform, to better make more active decisions, and to invest in those companies that can better, weather the storm during the volatile times.
Mhm. And it makes it difficult. And as you're talking about that, it's like just, find good active managers or passive managers, stick with them, have confidence in them, conviction over, and you were talking about, manager research, conducting due diligence, and, you do your correct manager research over time, have confidence in that person. And kind of stick with it versus trying to time the market or go active versus passive. Finding alpha is hard, right? And finding a consistent alpha. And I think that's what your research is showing, um, over time. Is it going to be hard moving forward, or do you think, we might be able to get a period where alpha is easy to find?
Yeah, it's a little bit back to not to harp on our short-termism of just investors overall, but I think just us as consumers, kind of that immediate need and gratification of, okay, if I want to invest in an active manager, they're expecting this to happen, very shortly. When you see certain stocks and companies pop so quickly as well. I mean,
Mhm.
it takes a bit of time for this outperformance to kind of to one persist, but just to kind of prove itself out as well. We don't expect this to happen quickly. I mean, honestly, in our view and opinion, if you see very consistent outperformance, like over the shorter term, right, that they're likely but much more active, much more tactical, and it's tough to then gauge kind of their current state of what you'd expect in the future as well. And I think that's a really important part of due diligence of active managers is evaluating their historical track record through their various market environments, how they've acted or reacted to certain market environments. Do they stick through consistent with their investment approach, continuing to invest in the same types of companies, and
Yeah.
then selling the companies when they didn't meet the marks and metrics as well. But very important. It takes a lot of time. It takes a lot of the qualitative due
Yeah.
diligence time, asking conversations to those portfolio managers, spending time with the analysts, better understand their view on certain stocks and companies. And it is a testament of what we provide to our clients at Envestnet that use our manager research and due diligence that are trying to decipher through all these mutual funds and ETFs and separate accounts and active, they're looking for an active manager, that knowing that's sort of embedded within our wealth tech platform, but as well as our own, products and strategies that we provide to financial advisors. Something I'm born and raised from that group. I spent a lot of time there, so I can speak to it.
Yeah.
But it's very valuable, but often overlooked, and it does take a lot of time. So, just
Yeah.
knowing and recognizing that for advisors. And Ryan, you mentioned that, like doing the due diligence up front and sticking with them as well. And there's some great active managers out there, have a long history of providing, good risk-adjusted returns over the long term in a cost-effective price.
Yeah. I'm glad you really brought up qualitative side. At Zephyr, we do a lot of manager research and due diligence, and you know, for years, it's a lot of quantitative side. Sharp ratio, Sortino ratio, returns, historic, you name it, all the different metrics. But really, the hardest part, and everyone, it's easy to compare, who has a better Sharp ratio or pain index and stuff like that. It's that qualitative side. It's really difficult to do the qualitative side. And with active ETF space, innovation, is it becoming even more difficult to do the qualitative due diligence?
Yeah, I think with launch of active ETFs, we saw a record year last year, Ryan, as you know, in terms of new
Yeah,
products coming to the market of active ETFs. I expect this year to kind of crush that record of, again, kudos to asset managers. They're listening, understanding what, the industry wants and needs. We know the benefits of the ETF wrapper in itself,
yeah,
and that started with the low cost passive. Now the benefits of getting active management within this ETF wrapper as well. But what that's opened up the doors to is a lot of very innovative, unique, sort of non-traditional active
yeah,
strategies now in this active ETF wrapper. So, Ryan, as we were talking about in our prep call, we feel for financial advisors or just investors in general when they go search and filter for, an active ETF, there's a lot of, for lack of a better word, stuff out there, and to get through the noise and say, well, this is a traditional active management. And I think it's just going to get even more complex. So for those advisors that are kind of listening out there, we feel you, we understand you. It's due diligence groups like we have an Envestnet PMC. We're looking through that, trying to get to true active, and then again recognizing some of the more non-traditional active. We see a lot of strategies that use more options within these active ETFs. There's benefits to that. It's great that they're bringing those down market and getting more of those types of strategies to investors, but it's a different type of strategy than we're used to with the traditional mutual fund wrapper or a traditional ETF wrapper. So the importance of quantitatively, you can look at that track record and it might have a better Sharpe ratio risk adjusted return, but knowing what they're investing in, knowing the benefits of what types of how it should perform in certain market environments. If it has more of protection on the downside, it likely isn't going to participate as much on the upside, especially this most recent, call it 15-20% rally we've had off the bottom here. You're going to see some of these trail, but it probably did a job on the bottom side as well.
yeah. Brooks, that's fantastic because these innovative active ETFs, I think some are fantastic, but we often talk about on this show, you got to really know what you're investing in. And financial advisors, I would hate to be in a position where maybe you put your clients in one of these very exotic active ETFs and it kind of blows up and having that conversation what was it, why. You really got to understand what's in them, use your team to really figure out on that qualitative side, what in the world is this thing? Is it appropriate? So you can have those tough, or maybe not have those tough conversations because you don't have to worry about it.
Yeah, yeah. Sticking to what you know. Um, Get some of these asset management firms, it's similar brands, so you're going to recognize the names, but there's a lot of new entrants, names and brands out there. And again, it kind of going along with the new innovative strategies as well that are coming to market. And we turn to research databases like Zephyr and other third-party firms too to help kind of better filter and look for these strategies. It's up to wealth platforms like ours to better kind of bucket these types of strategies appropriately as well to make sure advisors know what you're using in client portfolios and ultimately to end clients to better understand what they're investing in.
That's fantastic tips there, Brooks. So maybe here's a $1 million question. We've talked about all this, whether it's manager due diligence or, active versus passive, creating that optimized investment portfolio. But now clients or investors are demanding more personalized investment solutions. They want transparency, all this other stuff. Mutual funds is a different allocation doesn't work anymore. How can financial advisors do this all at scale? Because yeah, as we all know, financial advisors are pulled in many different directions. How can they do this at scale to make their practice efficient?
Yeah, and we're what we see a lot with our data financial advisors using our platform is they're doing a great job of not only, they've done a great job historically of smaller accounts, call it 500K and less, and using mutual funds and ETFs to manage their client accounts. But they're doing a great job as well now, the last couple of years of going after, higher net worth and clients as well.
Okay.
Part of that is a testament to, wealth platform technologies like ourselves. Part of it is a testament to the asset management industry, bringing more separately managed accounts, bringing more ability to customize capability there. But it goes back, from if I'm in a financial advisor perspective, and again, we work a lot with financial advisors to consult with them and help them scale and build their practice. Having that consistent investment approach, their investment philosophy of how they're managing their client accounts, whether it's smaller accounts where they're using mutual funds and ETFs or maybe
Mhm.
ETFs only, all the way up to that higher net worth. And with higher net worth, end clients expect that customization,
Yeah.
personalization capabilities. They expect to own individual securities so they could better tax loss harvest. So
Yep.
you're going to see more separate accounts within there. You're going to see more tax management in that. And what we see is that advisors scaling that, leveraging that one investment approach. It could be active passive. So from small account, and now you can scale that to higher net worth accounts by the inclusion of direct indexing for your passive management can piece. There's a plethora of traditional actively managed SMAs on platforms too. Very cost effective, great long track records. Of course, you're always going to have mutual funds and ETFs in there as well. And then
Yep.
overall, on top of that, all is the tax management capabilities of that, to personalize there to each individual's tax goals as well. Not just tax managing this individual fund or this individual SMA, but that tax management capability, which is really embedded in a lot of wealth platform technologies like Envestnets as well.
Yeah, technology has been a huge innovator in just helping financial advisors scale their practice, and I think it's going to continue, like you said, whether it's separately managed accounts or other products, direct indexing that also provides those ability to customize, personalize their investments. I had Dana on Dioria
Yeah.
a year ago. She was fantastic talking about scalability at Envestnet and doing some great things there. Lastly, you talked about your research and what financial advisors are doing, how they're using Envestnet and ways they're using it to provide scalability. What other data points or trends are you seeing maybe within the active ETF space? We're seeing trending to active ETFs. I think your data showed that recently a lot more flows from your advisor platform going to active ETFs. Do you see that continuing, or are there other trends that you're seeing
Yeah,
from
and
financial advisors?
yeah, Ryan, I've been, part of my role is getting a better sense and understanding of what's going on in the industry from a, asset manager community. What sort of products are they bringing to market? And then working with our research and due diligence team of uncovering those types of strategies and trying to, recommend and do the due diligence for our advisors. And so they can use them within client portfolios, or so we can use them within our own portfolios that we construct. And I've been a big fan advocate of active ETFs, and it started probably late COVID, where we really saw the ETF rule passing and seeing more and more product launches. We didn't see it, the data we have on the Envestnet platform. We didn't see it until literally
Oh,
last summer,
wow.
June, July. We saw that uptick of active ETF usage of financial advisors using more active ETFs, and there are various reasons as to maybe why kind of the correlations there, but it
Yeah.
was about 15-20% of the inflows onto the Envestnet platform of mutual funds and ETFs of going to active ETFs. But as I unpack that a little bit more, I think this is the interesting part, Ryan, is it's almost to our comments we said before. If I unpack that and look at the individual flows, I'm like, well, what is trending here? Like broad bucket, yeah, active ETFs. It
Mhm.
was a lot more of the more niche, esoteric
Okay.
active ETFs. It was those that were kind of more the buffered ETFs, those using
Yeah.
options, thematic ETFs, and third was fixed income active ETFs, and that could obviously where we're at in terms of interest rate environment and a lot more advisors going in the shorter end of the curve, and there's a lot more product options
Yeah.
and opportunity in active fixed income ETFs. They were kind of more the first to market. So we have some great strategies, great track records. That's where more of our coverage is there today.
Okay.
But over the next, to answer your question, Ryan, I mean, definitely over the next 18 months to 2 years, I just expect more and more advisor adoption of active ETFs. And really that a little bit of client advisor demand, yes, but we're seeing the industry kind of product innovation. We're seeing track records. We're seeing these firms invest and believe in the active ETFs. And it's just yes, another product wrapper, another option and choice, but now typically a bit more cost effective and also much more transparent and better trading capability and all the benefits of the ETF wrapper. So I don't see why this won't continue to trend. I don't think it's going to take away, the mutual fund is dead. We've had these conversations because when you really break down to it, there's limitations of the ETFs. There's benefits of the mutual fund of only pricing daily at certain asset classes where you need the mutual fund wrapper is a better wrapper to execute. And I would kind of warn advisors too, like don't go all in on ETFs or certain asset classes where just an ETF won't make sense from a liquidity perspective, from a pricing perspective, and,
Yeah.
and even sometimes from a cost perspective. There's still mutual funds have come down significantly in prices in the last
Yeah.
10 years. And and so there's benefits of both, and there's benefits to separately managed accounts as well.
Yeah.
So again, I feel for advisors that going through this plethora of investment options out there. Again, try to leverage your due diligence teams. Try to reach out to obviously your asset managers that can help make sense of this complexity of the universe as well. But again, part of my role here at Envestnet PMC, try to understand what's going on there
Yeah.
and get a good pulse there from the industry, but also from working closely with our financial advisors. I have great data from them. I also talk a lot with them and try to meet them in the middle and meet their wants and needs in terms of investment products to ultimately service the end clients. I mean, that's what our business is, really to make sure those end clients stay invested, meet their financial goals, their long-term goals, hopes and dreams and all that. And we're less about markets being down 2% yesterday and up 5% today. That's financial markets, and there's going to be volatility. And it seems like volatility is here to stay for at least for this year
Yeah.
when we get through all this.
Brooks, that's fantastic. Great way that, really recap this conversation. Like you, I like active ETFs. I'm a firm believer. I like active investment management, but now that's in that ETF wrapper, all the benefits that brings, I can just see this trend going, continue to expand. But you got to be careful of some of those active ETFs out there. Really make sure you know what you're investing in. I think that's, how financial advisors can leverage your team to really get a better understanding, where they, you know, how they use them, right, in a portfolio.
Absolutely.
Is it better for a mutual fund, active ETF, SMA? So be it. Brooks, if financial advisors do want more information or, questions for you, where can our audience get more information about Envestnet and PMC?
Yeah, best place to go is just investnet.com.
Okay. Perfect. Perfect. Brooks, thank you so much for coming on the show and sharing such great insight. I love this conversation, on the investment side, especially on analytics and stuff like that. It's a lot of fun. Really enjoyed it. Thank you for bringing all that insight. And thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other episodes on the Zephyr YouTube channel and Spotify. And please be sure to subscribe and follow us on LinkedIn. Thank you and have a great rest of your week.